Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. My name is Robert Kuhn. This is Destination Retirement. Thank you for joining us. If this is your first time, welcome. Hopefully you'll find that we are very educational in nature, and we want to make sure that we're doing all we can to educate you to help you not lose money. At the end of the day, I think that's the job of any advisor. If you are a repeat listener, welcome. If you're catching it on the podcast, again, that's awesome as well. Thank you very much. Investors really, and we're going to talk a lot about this week, but they hire us, they work with us, they talk with us. Because they're interested in building or having built hyper-personalized portfolios that are designed for your unique cash flow protection and growth requirements. Everybody's different, and unfortunately in this industry, it's broken in a lot of ways. Everybody thinks that they have the best allocation, they have the best advisor, they have the best strategy, and what they're doing is simply tracking the market up and tracking the market down. So I thought what we would do today is go over who and is reaching out, why they're reaching out, some of our conversations, and maybe if that is you and you want to have a conversation with my team, please call Paige. Paige can set that up for you, 630-492-1912, 630-492-1912 if you are outside of the Chicagoland area. But the show is airing in your market, then we can definitely work with you. We are expanding the reach of the show, so we're very happy with that. So if you are hearing us outside of the Chicago market, rest assured that we have a team member in the area that we can start the process of helping you really just audit your current financial situation. So 630-492-1912 if you want to have a conversation with us. So markets are what the markets are. It was certainly hot this week in the Chicago area. My goodness, it was hot. But in the markets were hot as well. And, I think when you look at, what is going on in the market, I think there are situations and instances that for professional money managers aren't adding up. And as you know, if you've listened to the show, there's generally two types of advisors. There's those that always look at everything through rose-colored glasses. It doesn't matter if we're in 2000 to 2002 and the markets are down, whatever it was, 10, 13, 19% in subsequent years, or we're in a 2008 where the market's down 37, peak to trough almost 60. Everything is great. Everything is rosy. Don't worry about it. It's perfectly fine. Markets are ultimately going to come back and it's okay. Feel good about losing money. And that's the one type of advisor. Then you have the other type of advisor that it's doom and gloom everything. And I can't tell you how many people that I have talked with over the better part of a year that have missed this market run up because their response is, well, the markets have to correct. They can't keep doing this. And the reality is, as we've talked about often on the show, is the markets can do what they want, when they want, how they want. They don't think, they don't feel. The market in many ways is gamified. We're going to go over some really interesting statistics this week on the show and just look at how narrow focused the market is as far as names that are really truly driving the market up. So when we, do the radio show, our goal certainly is that we're bringing to the table something new, something different, something that you're not familiar with, because far too many people, and I see it with portfolios that are $100,000, and I see it with portfolios that are, $5, $6, $7, $10 million. You really own three things. You own stocks, you own bonds, and you own cash. And I shouldn't say stocks. You own equities, you own bonds, and you own cash. And you may see, so many, different investments on your statements, but ultimately, you own three things. And it's no wonder that the majority of people listening to the show and the majority of people that we talk with, you're just simply tracking the market up, tracking the market down, and then who knows what's going to happen if the markets go sideways. And I'm always amazed in this industry that if you believe in a buy and hold or buy and forget strategy and you want to pay a fee for it, you are doing the advisor just the best service, because what an easy job that advisor has. Raise 100 million, 200 million, 500 million, $1 billion, whatever that number is, slap a fee on it, whether it's 0.5%, 1%, 2%. You can do the math, right? And it's just more of the same. But I'm here to tell you, and I talk with every single person that we have the opportunity to speak with during the week, that there is a good chance that your current portfolio is not being managed the way your advisor is managing their personal money. And you have to ask yourself why, right? I mean, why are you recommending something, but yet when you're managing your own personal money, there's a good chance that it's just not a buy and forget strategy and buy and hold strategy. And again, buy and hold works until it doesn't. And it may be 80% of the year, it may be 70% of the year, maybe 50% of the year, maybe 90% of the year. Who knows? But we don't want activity for activity's sake. But they're not managing the money how they manage their own personal assets. And the answer to why, I think, is really simple. It's easy to manage one person's money. Your own money, it's easy. And you don't have to scale it across 100 clients, 500 clients, 1,000 clients, or what have you. And so it's very easy to be active, and it's very easy to play offense and play defense. And I don't know why in this industry, playing offense and playing defense all of a sudden became, well, we're trying to time the market. We're trying to, guess the market. We're trying to outsmart the market. No, absolutely not. I mean, it's truly simple. We're trying to buy good investments that are trading currently at a discount. And I think we try to do that in every area of our life. I mean, you don't go out and buy a house and look at that house and it's, for sale for $100,000 or $1 million or whatever and say, yeah, I want the list price plus 10 or the list price plus 15% or 20%. Or you go to, get a purse or get a car or whatever it is. And whatever the sticker price is, I want to pay that plus 20%. But when it comes to investing in stocks, advisors, unfortunately, are the worst. And when you have hundreds of clients, it becomes very challenging unless you're set up from the jump to be able to actively manage portfolios. And the problem with a lot of what we see out there is model portfolios. And you may have 30 stocks, you may have 50 stocks. And, the investor today is coming into that same model when the investor a year ago was it put in that model? Maybe the risk reward, maybe the valuations, maybe things have totally changed where XYZ stock was a great investment at the time. Today, it's not a great investment because it's run up 50% or it's run up 30% or what have you, but you still are going to be placed in a non-customizable model portfolio, and it's just a challenge. So the people that are reaching out, it's really simple, 630-492-1912, 630-492-1912, and have conversations with us during the week. They're all over the board. People have 50,000, people have 5 million, they have 10 million. They are absolutely all over the board. But there's one consistent theme. And that theme is, I don't think my advisor is actively managing my money. And I think that I'm paying a fee to, in a lot of instances, drastically underperform the market. And I'm amazed by that. And so a lot of people are just not confident that their portfolio can withstand a market shock. And there's something brewing, I think, underneath the surface of the market. And when I say that, clients will, are you concerned? And I mean, I'm paid to be concerned and I'm paid to worry, at least when it comes to investing. And I don't know if it's going to be a credit event or what's going to take place, but something needs to break, and it doesn't need to, be catastrophic, but it very well could be catastrophic. But there are just things that are not making a whole lot of sense, and it's a challenge to us because our philosophy is always keep investors' money safe. We want growth, we want maximum growth, but we have to make sure that if we adhere to simple mathematics, if we lose less, ultimately we're going to make more down the road. And so clients are reaching out because they're not convinced that their money's actively being managed. A lot of times they're paying 1%, 2% a year, and they have a closet index fund. And what I mean by that is you are just getting the market good and the market bad. And for that right, you have the right to pay an advisor. And I think that's a challenge. And like we talk an awful lot about the dual directional notes. And, we just did one last week that traded on Friday. JP Morgan note, 15 months. And so it was really simple. You got 21% of the upside of the market. From 0 to negative 15, you actually made money. So 0 to negative 15 in the market, you actually received the inverse. So that's a positive return. So yes, if the S&P or whatever indices it was following were down 15%, you actually made 15% over the 15-month period. And then you had a big buffer on the downside. And that big buffer was if the markets were down 15% or more, look at negative 15 as your zero. So if they were down 16, you're down 1, 17, 2, 18, 3, etc. Well, that's something that's new to you. And it's backed by one of most of the big banks do it, Citi, JP Morgan. Most of them do. We've been doing a lot of JP Morgan dual directional notes lately. But think about that. So if you look at where the market is today, what are the likelihood that the market in 15 months from Friday is going to be up more than 21%? It could be. Nobody knows. Crystal balls are what they are. Crystal balls are crystal balls, but it certainly could be. The probability is it won't be. So in a lot of instances, you're probably going to capture 100% of the upside of the market. And if not 100%, most people will be content with a 21% rate of return over 15 months for some money. Again, it certainly doesn't need to be your entire portfolio. But then from 0 to negative 15, there is a very high probability that we could be down in 15 months, and especially into an election year, anywhere near 0 to 15%. And if you can still have an investment that if the indices that it's tracking, say the S&P are down 15% and you're still going to make 15%, well, guess what? That's an advisor that is adding significant value. And those are the things that we want to talk about. So people are calling in because they don't feel like they have a hyper-personalized portfolio. They think it's just the market. They think it's more of the same. A lot of individuals have lost a tremendous amount of money in fixed income. I've seen $2, $3, $5, $7 million portfolios that are flat for the year, up maybe 2 or 3%. And it's because the fixed income drag. And, you look at fixed income. I mean, unfortunately, you're looking at a period of time where, we're still in the worst, 2 to 3 year period in the fixed income market. Does that mean that you shouldn't have fixed income? Well, I'm not saying that. But what if we could have had a strategy in place that didn't have any interest rate risk, that didn't have any interest rate sensitivity, that was able to protect your money or was able to give you 10, 10.5%, 11% as long as the markets didn't go down 40. I mean, those are the types of investments that we want to make sure that that you have some investments that are defined outcome strategies, DOS, defined outcome strategies. And that's something we're going to talk an awful lot about because it's a niche. It's our niche. And we can use the private banks. We can use the big institutions. We have the relationships. And we can invest in a defined outcome strategy that simply we know the math going in. We know the math of what we're going to make on the upside. We know how we're going to lose money. Can we make money when the markets are down? I mean, we just have the possibility to perform in all markets, up, down, sideways. And the reality is these strategies, when we started doing these strategies in 06, 07, and 08, you had to be accredited. So you had to have, $1 million net worth. Generally speaking, the minimum investments were significant and outside of where it made sense for the average person to invest. But with technology, these investments have come down. The minimum investment is $1,000. Think about that. $1,000, and they're sold in increments of $1,000 with no maximum. So if you look at your portfolio, you have to ask yourself, do I have any defined outcome strategies? And if you don't, you truly owe it to yourself to give us a call and let's have a conversation. So 630-492-1912, 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. My name is Robert Kuhn. I'm the host of this fantastic, hopefully you share that sentiment, fantastic radio show. If nothing else, hopefully you believe that we lead with education. To me, I'll take that. So we are a fiduciary. I'm also the president and founder of Kuhn Capital Partners. We're a fiduciary. We're independent. We're a registered investment advisory firm. Yes, we do focus on financial planning. I think financial planning is very, very important, but there is a disconnect. A lot of times people will do a financial plan, it's one and done, and they don't connect the financial plan to the portfolio construction. And the technology that we use allows us to integrate the financial planning process and results within the portfolio construction. That allows us to deliver hyper-personalized portfolios for every single one of our clients. So 630-492-1912 if you'd like to have a conversation with myself this week, 630-492-1912. We're doing a lot of portfolio audits. It is complimentary. Doesn't cost you anything. We have a secure site that you upload your statements to, and we'll run our thorough portfolio analysis, whether you have 1 million or 10 million, or 10,000 or 10 million. It really doesn't matter to us. We're going to do the thorough portfolio audit. We're going to look at fees. We're going to look at performance. We're going to benchmark it versus the averages. And we're just going to give you a really good understanding of, possibly what you don't see, because it's, you always, especially in this market, it's always nice to at least know what could happen before it does. And when we do that portfolio audit, part of it is stress testing the current portfolio. That's a big deal. And, most people don't know how to do it. And we absorb that cost for the software that is not basic. It's very in-depth. It's very thorough. It's cutting edge. And we can do, through our portfolio audit, we can certainly stress test the interest rate sensitivity, the equity sensitivity, the what ifs, your future income sensitivity. How much can you have? How much should you have? What do you have to do to get a raise? Unfortunately, in this industry, very few people know what you have to do, what has to happen for you if you're drawing out money out of your investments. Of how much do my investments have to grow before I can actually take a pay raise? Our Income Labs technology and our Income Labs software allows you to actually visually see it. And if you're still using the old school of thumb, the old rule of thumb, the 4% rule, it's dated and it's stale. And it's just, again, like most of financial planning, it's just like, because it worked 20 years ago doesn't mean it works today. Just look at technology. So we utilize technology. We build hyper-personalized portfolios. We want to have growth. We want to have protection. We want to have tax advantage strategies. We want to have cash flow strategies that can produce cash flow to you irregardless of what is going on in the market. They're not dependent upon the market. So give us a call, 630-492-1912, 630-492-1912. Paige, my great assistant, we'll certainly set some time up for us to have a conversation. If you're listening to the show, as I mentioned, every segment outside of Chicago, we are expanding the show and the reach into new markets. So if you're hearing the show, we can help you. So 630-492-1912. So a lot of people are concerned with the markets. I think, when you look at what's driving the markets, a lot of these statistics are kind of, I hate to say once in a generation, because it seems like if anything that we've learned in the market is the unexpected or the outlier happens a lot more than one would believe. And that's one of the problems with financial planning. The bulk of investment advisors are using financial planning software that's just looking simply at Monte Carlo or probability analysis. And it looks very professional to you. It looks amazing. I mean, it's fancy. The sheets, the graphs, the charts, they all look really, really good. But that's just stale data. And that's not the way, in our opinion, that is going to give you the most cutting edge and the highest ultimate probability of ultimately whatever your success is, because many people don't realize that outliers happen. Look at, let's just go back to 2000. We had 00, 01, 02, then we had 08, and then, we had, inevitably what happened, up and through 2018. And then we had 2022. And certainly in 2020, now the markets were positive, but you had COVID. And so, a lot of individuals are, asking, what do we think of the market? And, when we look at just 5 stocks account for 2/3 of the NASDAQ's year-to-date returns of 36.3%, that's concerning. Now we'll take it. Right. Gains are gains. I'm always one to take gains. But again, if you are still using diversification, meaning you have to cover all of the style boxes, large growth, large value, small, mid growth, small, mid value, international, emerging markets. That those days are, if you have $10,000 or $100,000, maybe that's appropriate. But anything more than that's just not truly investing today. And I think when you look at, the NASDAQ performance for the year last week, who knows what it's going to do, going forward, but 36.3%, the top 5 stocks accounted for 22.8%. NVIDIA was 6.7%, Microsoft was 4.7%, Apple was 4.5%, Amazon 3.5%, Meta, which is the old Facebook, 3.4%. So, you look at that concentration, and a lot of people have missed out on that. A lot of people are still using gut feel. A lot of advisors are using gut feel or over diversification. You don't hear that term talked about an awful lot, but it absolutely is the case, because you look at somebody who has mutual funds. I'm still amazed that unless they're very targeted mutual funds, and there are some out there, but it's less than, certainly less than 1%, and maybe less than 0.5% of all mutual funds. But I'm still amazed that people who own, who have over, a couple $100,000, 500,000, $1 million plus, are still using mutual funds. Why? Not tax sensitive or tax efficient in any way. And we're going to talk about taxes here in a minute. Not customizable, not transparent. There's so many things wrong with mutual funds unless you don't have a whole lot of money. Then it can give you, the diversification that you need. But if you have over a couple 100,000 and certainly over $1 million, if you're paying an advisor to then own mutual funds, look at the fees. You're paying the advisor fee, you're paying the fund fees, and, it starts to get to 2 to 3%. So, the markets are very, unfortunately, they're very concentrated at the top right now. And, it can continue that way. But, if you just look at, just reversion to the mean, there certainly is a chance that ultimately it's not going to continue that way. But again, we don't want to go on gut feel. We want to go on math. We want to go on statistics. And I think that, to me, is why investors hire us, because we're doing things different. We're bringing in, like I mentioned, the dual directional notes, where you can still make money if the markets are down, or we can get, over 10% if the markets aren't down 40%. Again, defined outcome strategies. So DOS, defined outcome strategies. And if you don't have any, and again, it doesn't matter if you have 100,000 or 10 million, if you don't have defined outcome strategies as a core component of your portfolio, you may not like the results if we do see a down or long sideways market, or a pretty, violent down market. And we're here to help. So 630-492-1912, 630-492-1912. I want to go over 6 qualities that I've read about that a successful investor have. I'm going to debate them, and we'll certainly touch on those towards the end of the segment and into next segment. But I want to talk about tax strategies. I want to, talk about strategies that can greatly reduce your taxable income. When you look at financial planning, and the most overlooked area of financial planning, in my opinion, is tax planning. And I'm not talking about just trying to tax loss harvest where I match gains with losses, et cetera. We're talking about strategies that can greatly reduce your taxable income. And there are strategies that can reduce your taxable income by 75 to 85% of the investment. So you put in 100,000, 75,000 to 85,000 is immediately going to come off your earned income, your capital gains, your 1099 income. And these are strategies that are readily used. And again, if you're working with an advisor at a big bank or a big brokerage firm, you don't have access to these strategies. You simply do not. They can tell you they do. Then your simple answer is, okay, show me. Give me an investment that'll reduce my taxable income 75 to 85% of whatever I invest, and just sit and wait. And you're not going to get any, unfortunately. And that's the problem with working, in my opinion, with a big bank or a big brokerage firm, is lack of solutions. Very plain Jane, very vanilla. And when you look and you work with a registered investment advisory firm like ourselves in the fiduciary, we can bring to the table strategies that if you put $1 million in an investment, we could reduce your taxable income by $750,000 to $850,000. You put $100,000 in, you do the math, $75,000 to $85,000. So you sold a business, you sold property, you are a high wage earner, make, north of, $500 to $1 million a year. You're paying a lot in taxes. If you're paying a lot in taxes and you're not happy with paying those taxes, call us. Let's talk about our tax advantaged strategies that we have to invest in. Not only are we getting 75 to 85% immediate deduction from the tax that is due. These strategies are cash flow producing. They may produce 10% a year. They may produce 15% a year. And they're, generally speaking, independent of the stock and bond market. So you look at, what endowments do. You look at what institutions do. They invest in these strategies. They're classified as an alternative asset class. I think anything that's not a stock or a bond is an alternative, but they're energy strategies. There are, so many strategies, and there are a couple that, one in particular that we use that, allows for significant tax reduction. A lot of people that we work with sold buildings, sold businesses, or had a great year, or had, a record earnings year, or are just tired of paying taxes. And they want to know if there's any strategies that exist that can greatly reduce their taxable income. And I'm here to tell you that they are. So if it appeals to you that you put in $100,000 and you can reduce your taxable income or offset capital gains by $75,000 to $85,000, or if you invest $1 million and you can reduce your taxable income by $750,000 to $850,000, and you own an asset that is tangible and is an asset that pays, generally speaking, significant cash flow on an annual basis, then we need to have a conversation, because let us educate you on what it is and what it's not. And we're very, very, it's becoming, especially with where we think the tax rates are going. And you look at what, certainly here in Illinois and really other states, it's, taxes, generally, many people don't think that they're going down. Well, we're able to help you reduce your taxable income. You have two choices: pay the government, or use every advantage that's available to you and reduce your taxable income, put that in an income cash flowing asset. And, generally there's a lot of things we have to talk about, but generally it's time commitment with those. And those investments are, generally 1 to 3 year type money, and some are more certainly, but those are the things that we need to talk about. But when you look at how they are reducing your taxable income and still producing significant cash flow, again, it's one of our 4 components of a portfolio plan, which is tax reduction and cash flow. So with that being said, we'll go over 6 qualities that they say you need to have to be a good investor, whatever that is. So 630-492-1912, 630-492-1912. Call Paige and set some time up for us to chat this week. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. I'm also the host of this radio show, Destination Retirement. We are based out of Chicago. If you are hearing this outside of the Chicago market, understand that we have representation and we have people that are part of my team that we can work with in your area. We are generally, that also includes myself, because we do have a national client base. If you're a commercial airlines pilot and we haven't talked, if you're with United, American, Southwest, JetBlue, etc., FedEx, UPS, then we really need to talk, because we are in that space and we know a lot of your options. And if you have a 401k and you're still working, understand that in a lot of instances, if you're 59 and a half, you can take that money and move it to an IRA. So we can bring cutting edge strategies to you to utilize. So nothing changes in the plan. You're just taking the lump sum and moving it out. And the tax code in most instances allows you at 59 and a half to do that. Well, the tax code always does. Sometimes your companies don't allow it, but most of the time they do. So 630-492-1912, 630-492-1912. So far, I think we've talked an awful lot about kind of just being different, right? And having different strategies, and not having a closet index fund, not having a portfolio that simply goes up and down with the market and you pay a fee to an advisor, having active management. And we can break down our philosophy really in 4 areas. And we want to make sure that we're bringing these 4 areas to everybody, whether you have $100,000 or you have 10, 15, 20 million. I mean, I don't think it changes. Maybe some of the strategies change, but the philosophy doesn't. So we always want protection. We want strategies first and foremost that can protect. Now, everybody's portfolio percentage to each strategy is probably going to be different. That's based upon where you're at in life, what your tolerance to risk is, what kind of personalized growth assumptions you need to hit your goals, etc. But we want to have protection. Protection could be 100% principal protection. Protection could be strategies that give you 20% of the upside. You still make money if the markets are down to a certain extent or to a certain level. There's just so many different strategies that we would classify as protection. And if you're still using fixed income, look at your portfolio statement. If you've lost a lot of money in fixed income over the last 3 years, we need to have a conversation. 630-492-1912, 630-492-1912. So we have the protection. So when it comes to growth, growth is very important. Growth is very important. Look at inflation. We don't think inflation is going down. The greatest, what is it? The 7th wonder of the world is compound interest, compound growth. I think one of the greatest destroyers of that are large portfolio losses. If you've talked with us in the past, the industry has not done a good enough job explaining just how bad and just how destructive 20% losses are, 15% losses are, 40% losses are. And advisors just take it like, well, okay, it's going to come back, keep paying me your fee. Well, why didn't we address this beforehand? Why didn't we have a portfolio that was set up that had at least a bucket of money that could protect or even make money in a down market? And so that's, those are the things that we're bringing to the table. So when it comes to growth, we want hyper personalized portfolios, individual stocks. We don't want mass model portfolios. If you have over $100,000, we don't think you should own mutual funds. We don't think you should own index funds. I think it is truly a stock picker's market. We want to make sure when we're looking at our growth bucket that we're trying to buy an asset that it may be buy $1 worth of an asset for 60 cents, 70 cents, 80 cents, something cheaper than ultimately the intrinsic value of what we think the company is worth, a company that has a large moat. I mean, you look at kind of our growth side, it's totally different. It's not we believe in themes and it's, we'd love to share it with you, but we want protection. We want growth. We want opportunistic growth. I mean, opportunistic growth is, it may only be 10% of your portfolio, but you just look at some of the names today. We mentioned earlier that 2/3 of the NASDAQ returns are coming from 5 stocks. I mean, think about that. So why can't we overweight some names that are proven or continue to prove that it seems like, Wall Street has gamified the market a bit and all of the money is flowing to just a handful of names? Why shouldn't you participate in that? So we always want opportunistic growth as well. So far we have protection, we have growth, we have opportunistic growth. And then lastly, we want cash flow and tax strategies. So when you look at cash flow, we want strategies that can pay 10%, 15% cash flow that act independent of the stock and bond market. We want strategies that can greatly reduce your taxable income. Please hear me. Strategies that can reduce your taxable income by 75 to 85% of whatever you invest. That can, if you want to do Roth conversions and you have cash in investable money, that we can do a conversion and then invest in a strategy that can greatly reduce your taxable income. Maybe you're not getting taxed on that conversion. Maybe the $500,000 or $1 million or 100,000 or whatever that number is that you're doing the conversion on an IRA to a Roth, that's earned income that's income for that year. And so what if we took some money that is outside of that strategy and invested it in a strategy that had significant tax benefits? Well, guess what? Maybe you're mitigating some or all of that additional tax due by doing the Roth conversion. So these are the strategies that we want to talk about. So those are the strategies that make us unique. So again, protection, growth, opportunistic growth, cash flow, and tax strategies. 630-492-1912, 630-492-1912. Okay. A couple things. I love to read. I love Twitter. I love statistics. I love anything that comes, when it comes to the market and psychologically, I think it's so critical. And behavioral finance just absolutely fascinates me. And I love articles that say you need to have these characteristics to be a good investor. And some I agree with, some I don't agree with, but I just kind of want to share with you what is being, shown, what is being, what's out there rather, and what people are seeing, because some of it is just gobbledygook and some of it actually makes a whole lot of sense. But I think, a lot of people will say you must be, you have to control your greed, and you have to be fascinated by the investment process. I don't know if that's true or not. Generally, when I manage money, I think this is the only thing that is happening in life: the market. And, people walking down the beach and people walking downtown, and you get ready to retire, you're really probably not obsessing with the economy, the market, like I am and like my team is. And I think that's just why people hire us. First off, I mean, we have to live it, we have to breathe it, and that's just who we are and how we operate. So I think, I don't think necessarily you have to be fascinated by the investment process. I think you have to find an advisor, a team that is independent, that is a fiduciary, that's not part of a big brokerage firm or a big bank, because you're limiting your options. But you have to work with an advisory firm that has portfolio options that can do well in an up market, that can do well in a down market, and that can do well in a sideways market. Doesn't mean they will, doesn't mean they'll work in every market, but rather than just owning stocks and bonds and cash, again, we've talked about them all episode, we have to bring in strategies that have a different return driver. So I'm not sure that you have to be fascinated by the investment process. Most aren't. But I do think you need to control your greed. I do think that is the case. And, I've seen statistic after statistic that show that just because you answer a risk tolerance questionnaire and you're aggressive, you're really not aggressive. I mean, aggressive is, generally speaking, you lose 20 to 30 to 40% and you're still comfortable. You still sleep at night. You're not worried. That generally doesn't happen. So we do have to control greed. And if we have a longer term time horizon, not, please don't hear that we're going to accept losses and you're going to get, ultimately it's going to come back and this and that. And, we're in the worst 3-year period of the bond market, or the fixed income market rather. And we didn't do anything to address that beforehand. I mean, that's not us. We're going to be proactive. We're going to be cutting edge. But I think you do need to have some patience. And, that leads me to what they say you have to do is you must have patience. And I think there certainly is some truth to that. You have to have patience if you have the right strategy. That's the key. If you own stocks and bonds and cash, that's not the right strategy. Patience aren't going to do you anything there. You're simply at the mercy of the market. You're going to do fantastic in up times. You're going to do probably terrible in down times. And yes, the markets do go up, statistically much more than they go down. But what if they go down when you need the money? What if they go down when you retire? What if we go through a 3 to 5 month year or 3 to 5 year period where the markets don't grow and you are forced to retire or it's time to retire? Well, then patience didn't mean anything. So, if we've talked about, if you've listened, if to the radio show, if you and I have talked in the past, that if you bought Microsoft in 2000, it took you 14 years to get back to even. 14 years. That's not, that those are just facts. And so good companies, great companies can stay down for a lot longer than you think they can. And that's what we try to convey. So and the next, nugget that they say is you have to think independently. I think you have to think independently. You have to have an advisory firm that thinks independently. It's very easy to just do what everybody else does. There's safety in numbers. I've always said that. Everybody's losing money. Well, so be it. Everybody's losing money. You can't think that way. You have to have an advisory group that does think independently, that does think that, we don't just want to own stocks and bonds, because institutions, high net worth, pension funds, they don't do that. Institutional money, the advisory firms that, the principals at the advisory firm that you're working with, they probably don't have that, their portfolio allocated that way. The bank, the brokerage firms, they're not doing that with, generally speaking, with the firm's money. So you do need to think independently. You have to have things that you don't readily, fully understand. I mean, look at the dual directional banknotes. Most people don't know what they are. Well, you get a cap on the upside. The one we did Friday was 21%. 15 months, are you happy with 21%? You get from 0 to 21%, you get 100% of the return. 0 to negative 15, you actually get the inverse. So if the indices it's following are down 15, you get positive 15. And then if the indices that it's tracking are down more than 15, well, then that's your 0. So down 16, you're down 1, 17, down 2, 18, down 3, etc. So yes, we do think independently, and we think that's very critical. So we'll get to the last 3 after the break. You're listening to Destination Retirement. To give Paige a call, set some time up for us to have a conversation this week. 630-492-1912, 630-492-1912.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. I'm also the host of this radio show. Thank you. If this is your first time, welcome. If you're a repeat listener, thank you and welcome back. If you're catching it on the podcast, please send it on to somebody that you think needs to hear our message. As you know, that we are based out of the Chicago area. We do have a national client base, and this show does run in much nicer markets in the winter. So if you're in one of those markets and you're hearing the radio show, please understand that we want to talk with you. We want to help you, and we can meet as well. So 630-492-1912, 630-492-1912. If you want to have a conversation, Paige can set that up for us this week. So top 6 factors or items or qualities or characteristics to be a good investor. Some I agree with, some I don't agree with. Again, control greed. That was the first one. Yes, I do believe with that. You have to have patience. Patience only if you have the right portfolio. If you only have stocks and bonds and some cash, all the patience in the world, I don't think are going to do you very well. So we have to certainly have a conversation. Independent thinking, absolutely. We are independent thinkers. We are independent. We're a fiduciary. So we have strategies that can protect some or all of your downside. We have strategies that can reduce your taxable income by 75 to 85% of your investment. So hear me, $100,000, you'll get $75,000 to $85,000. You'll be able to reduce your taxable income the following year, or reduce capital gains, or reduce the income that you generate from doing a Roth conversion. Put $1 million in, $750,000 to $850,000 that you can use to reduce your taxable income, and all of those things I just referenced. And it's and still they're paying significant cash flow, which I consider significant, generally speaking, 10 to 15% a year. And, you know, those are the things that we want to have conversations about. We want to go over the pros. We want to go over the cons. We want to go over the risks. We want to see if it ultimately makes sense for your portfolio and your goals, your objectives, and what you're trying to accomplish. So 630-492-1912 if you want to have a conversation this week. Paige will set that up. 630-492-1912. So, okay, number 4, you must have security and self-confidence that comes from knowledge without being rash or headstrong. I think I agree with that. I think there's a lot of anchoring that happens. You know, you fall in love with a stock, or you fall in love with a trade or an investment that you did, or something that you did because you thought you were right. And it's very hard to admit when you're wrong. And so there is a lot of anchoring that goes on, where generally speaking, you're going to gravitate to news that fits your narrative. And that's not bad. I think a lot of that is just, you know, human nature. And it doesn't matter if it's politics, if it's money, if it's religion, if it's sports. Generally, we're going to gravitate with somebody who, makes me, reaffirms whatever it is that I thought I was right, or that I thought I was wrong. And that can be dangerous when it comes to investing. And I think people hire us because, first and foremost, we always understand and respect that it's your money, and it doesn't matter what we think. If you decide to do something, who am I to tell you what to do with your money? It's hard-earned money that you have worked hard for. You've saved and maybe made some great investments, or in your business. You've raised the ranks, or you took the risk and started a business. So we're not going to tell you you're wrong. If we don't agree with you, we're going to give you the other side of the story, so you can at least make an educated decision. And I think that, to me, is one of the greatest differentiators of what we bring to the table versus what other advisory firms are doing. I've seen far too often people will yes whoever they're in front of to death. Yes, you're right, you're right, you're right, you're right. And just to get you as a client. We don't want to do that. We don't need that. We will not take a client if we just, totally disagree in what you're trying to accomplish and the path that you want to accomplish it in. If we don't agree with that, as much as you have the right not to work with us, we have the right not to work with you. And I find that a lot of people respect that, because they know that if we tell them something, we believe it. And it's generally based upon facts, financial science, statistics, and doesn't mean we're always right. Of course not. But there's really fundamental, a kind of, auditing and thought process that goes into our decision making. So, yeah, you have to have self-confidence, but you can't think you know everything. I mean, how many people know, who are listening, what a dual directional note is? And we talk about them all the time on the radio, and a lot of our clients have them. It's as basic as it gets. It's a defined outcome strategy, DOS, defined outcome strategy. We know going in, here's our upside, here's our downside. Can we make money when the market's down? Yes. What happens if the markets go down X percent? How much can we lose? We know going in mathematically that here's what it is, here's what it's not. And what I have found is, when you can take away a lot of the uncertainty of the downside and still potentially make, like the one we did Friday, 21% of the upside. So in 15 months, if you are happy with 21% of the upside of whatever indexes the note was following, it was an investment that was JP Morgan backed note. You still made money when the markets were down 0 to 15. You actually got the inverse. How many strategies that that can the markets that it's tracking if the market's down 15 where you're still positive 15, and then how many investments do you know that if the markets are down 20, you're only down 5. So look at your negative 15 is 0. How many other strategies that that as long as the indices that whatever the investment or note is tracking are not down more than 40%, you can still make 10.8% a year. I mean, these are the type of defined outcome strategies that we want to have conversations about. Tax strategies. I mean, we've talked an awful lot about it. If you want to reduce your taxable income, invest in strategies that provide significant tax benefits. Generally, they're in the energy space. There's some phenomenal investments. Let's have a conversation. So yeah, you want self-confidence, but you also don't want to anchor. You want someone independent that's not emotional, that can just give you advice. And again, okay, be flexible of the types of investments you have, but never pay more than what a business is worth. And I think that comes down to individual stocks, and advisors are the worst. And again, and one of the reasons I say that the way they manage their own personal money is generally different than the advice that they're giving to other people is because it's easy to manage one account, one strategy versus managing 500 to 1,000 different clients. And that's why you have these model portfolios. That's why you have these one size fits all strategies. And unfortunately, that shouldn't be good enough for you. And there are advisors like our firm and advisory firms like us that don't adhere to that, that we really truly believe in hyper personalized portfolios, and everybody's different. And, when you look at never pay more than what a business is worth, I mean, my goodness, that's hard to do if you have hundreds and hundreds of clients. So, it all comes back down to making sure, if I can leave you with any thought today is a couple. First off, you beat the market by not losing money. Over the long term, if you lose less when the markets are down, you're going to beat the market, period. Number two is you have to look at strategies that can greatly reduce your taxable income. I can't talk about that enough. If I could spend this whole radio show simply repeating over and over again, strategies exist that can reduce your taxable income by 75 to 85% of your investment. 100,000, you reduce your taxable income by 75,000 to 80. $1 million, 750,000 to 850,000. You want to do a Roth conversion. You want to reduce, a business, a building, anything that you sold that you have capital gains. You want cash flow strategies. These are the things we have to talk about. I would say that over and over and over again, because I think that is, ultimately one of the greatest advantages that we bring to the table are tax efficient strategies. And then lastly, when you look at, income planning and future income, I like leveraging banks. I like leveraging insurance companies. I've found that people can sleep better at night if they know that, their needs are met through various, guaranteed type sources or sources that have very low probability of ever not working. And that allows you to invest more for growth. So with that being said, hopefully, you take something away from the show each and every week. That's my first and foremost. That's my goal. If we can help you, if we can have a conversation, if we can answer any question, no question is too small. Just really simply give Paige a call. Set that time up for us to have a conversation this week, whether you're in Chicago or you're outside of Chicago. If you're listening, we can help you. 630-492-1912, 630-492-1912. Have a great week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.